A hawkish Federal Reserve and expectations of increasing interest rates have kept major stocks pressured over the month of September. The higher rates for longer narrative from the latest Fed meeting has helped push up US yields and US interest rate expectations, which is naturally more challenging conditions for US companies. Higher levels of debt repayments, lower levels of consumer disposable income, and concerns about how high rates will actually go are all a natural headwind for US stocks, and we saw stocks pressured during the month of September. However, do you know that there is a very strong seasonal pattern for the fourth quarter for US stocks? And if you take a look at the Dow, the NASDAQ, and the S&P 500, you can see that from October, through to December, it tends to be a very strong seasonal pattern. If you take sort of from the first week of October into the end of December, an average return of 5.8% for the Dow, 88% winning trades. Look at the NASDAQ, you'll see a very similar picture as well. So just looking here at the NASDAQ, there we go. Average return 6.72%. Let's look at the S&P 500, and again, a very similar pattern, 5.21% average return. Now, the major risk here, of course, is that previous seasonal patterns don't necessarily repeat themselves each year. And perhaps there'll be some incoming US data which will alter the expectations for the path of US rates. But remember, this strong seasonal pattern is in play, and it's definitely worth being aware of. Remember, don't just trade it, season exit.